the depression of 1890, the collapse of 1929, the dot-com bubble of 1999, the global financial crisis of 2007, and most recently the coronavirus crash in 2019-20s. This cycle predicted each of these events. And what is most surprising, it was published back in 1875, that is, about 150 years ago. That is, someone else was then able to predict all the major and even minor crashes that would occur. Can you imagine that? If you knew all this, you would be able to plan all your investments for the next 50 to 100 years. If you had followed this cycle, you would have sold assets just before the peak of the 2007, bought again at the bottom in the 2009, then sold again at the peak of the 2020, and bought the attack again in the 2023. You would get about 700% of the profit on the S&P 500 index. And of course, this cycle also works for other assets that correlate with the stock market. If you applied it to Bitcoin, for example, and started buying and selling it from the year 2017, based on this cycle, then your profitability would be 3,549%. And you may be wondering, what are the risks? If something so good exists, why hasn't everyone around us become billionaires yet? And yes, you're right, there are reasons why not everyone has become a billionaire yet. That is why in this video, I will tell you what kind of cycle it is, how it is connected with land and real estate. Then I will directly explain the risks and reasons why not everyone has become a billionaire yet. And also tell you how you can circumvent these risks in order to maximize profitability based on this cycle. First, let's figure out what kind of cycle it is and how you can make money on it. It's called the Benner cycle, and it was compiled in 1875 year by a famous predictor of commodity markets named Samuel Benner, who was well known for his forecasts back in 1800 years. And perhaps you have already seen this graph, which I am showing now. It is published on social networks from time to time. The reason this cycle is surfacing publicly again is because people are starting to notice how frighteningly accurate it turned out to be. The Benner cycle predicted the depression of the 1890s, the collapse of the early 1990s, the panic of 1910s, the Great Depression of the 29th, and so on and so on. And more recently, this chart showed a peak in 2019 and a fall in 2023. Not bad, considering that this forecast was made 150 years ago. How does it work? When Benner created this graph, he believed that time has a pattern. He believed that this pattern worked regardless of wars, panics, or elections. To uncover this cycle, he used three main data sources. First, historical price data, IDS data on past prices. Secondly, weather patterns, how the weather changes from year to year. And thirdly, astronomical and astrological phenomena, for example, the cycles of the sun and moon, and how they affect human prejudice and behavior. Through this, he created his cycle. And Benner became known as one of the most accurate economic predictors of his time. He was so good that even Edward Dewey, director of the Cycle Research Foundation, analyzed his forecasts for 60 years and called them the most outstanding price forecasts in history. So, how do you actually read this loop? If you look at the cycle graph right here, you'll see three main horizontal lines. Line A, B and C. Line A. This is the topmost line. It shows the years in which panics occurred and in which they will occur again. And here we are talking about a complete collapse, very loud collapses that greatly affect the economy. Line B, IDS, the middle line, shows years of prosperity, high prices, and a good time to sell stocks and other assets of all kinds. This is the best time to sell stocks, real estate, goods, land, because it is at this moment that all this is expensive. Both line A and line B are a good time to sell and save capital until the market reaches the bottom. According to the Benner cycle, the bottom comes on the C line at the bottom. This line shows years of hard times, but also low asset prices. This is a good time to buy stocks, land, goods, real estate, and other things. Then it remains only to wait for the rise to sell everything at a new peak. This line indicates the right time to buy at a low price. For example, the last such moment was in 2023 year. And indeed, Bitcoin then reached the bottom, as well as the total capitalization of alt Bitcoins. Now let's discuss the risks associated with the Benner cycle and really understand if this cycle is so good. Then why hasn't everyone become billionaires yet? First of all, the reason you haven't heard of a lot of people who have become ultra-rich thanks to this cycle is that it's not very widely known. It hasn't become popular yet. And like any prediction model, this one has an error in accuracy. This is especially true for determining peaks in the stock market. Often the forecasts for the Benner cycle are a year earlier or a year later. Nevertheless, he accurately predicted the depression of the 1890s, the panic of the 1990s, the Great Depression of 1929, and so on, and so on. And more recently, this cycle showed a peak in 2019 and a recession in 2023. This is not bad, considering that the forecast was made 150 years ago. So in general, I believe that if you take into account a small margin of error and include it in your long-term investment plan, you can still earn a large amount. Personally, I combine this cycle with other reliable indicators to minimize this error. These are, for example, technical indicators such as the Shiller coefficient, the ratio of total debt to GDP, the inversion of the yield curve, and behavioral indicators. The Shiller coefficient measures how overvalued or undervalued the market is. It is calculated by dividing the market value of the S&P 500 index by its average profit. And now we have this coefficient at the level of 34 and 2. Despite all the recent events, this figure is still higher than in 1929. However, it is already lower than it was during the dot-com bubble. Then it was 43 as much as 31 hundredths. At the peak of 2021, it was 38.58. I would say that it is worth selling when it approaches the marks of 40 and above. But of course, it needs to be counted with other indicators. One of them. This is the ratio of total debt to GDP. And here it should not be confused with just external debt. Total debt includes household debt, private debt, and public debt. The third indicator, which is also worth paying attention to. This is the inversion of the yield curve, which reflects the difference between short-term and long-term returns. If the yield curve goes from flat to inverted, this is a very strong signal that the market may collapse over the next 8 to 12 months. And this indicator is usually extremely accurate. In simple words, the inversion of the yield curve occurs when short-term interest rates become higher than long-term ones. This is usually a strong signal to the economy that there will probably be a recession within 8 to 12 months. Since 1955, every recession in the United States has occurred after the inversion of the yield curve. It is interesting what is happening to it now, because at the moment the curve has moved from inverted to flat. This happened due to the fact that the steepness of bond yields rose sharply, and it started after Liberation Day. The yields of 2- and 10-year bonds began to move so as to level off after the inversion. That's why the curve has straightened out, started to come out of inversion, and the spread has become positive. What does this mean? Previously, investors tried to stay either in short-term bonds or in protective assets like gold. But now the curve is normalizing, which means that capital outflow from protective assets is quite possible. Perhaps that is why we are seeing a drop in gold and gold sales even from China. In any case, traders are now saying that the next black swan of the market may be a sharp increase in the steepness of profitability and its decisive exit above zero. This is a very interesting indicator that needs to be monitored. Now let's look at how the Benner cycle has changed over the years as we have collected more and more data. Let's take a look at one very similar cycle, namely the 18-year real estate cycle. More precisely, the 18-6-year real estate cycle. This is one of the cycles that Benner used when creating his model. And I want to consider this cycle because unlike the Benner cycle, which has not been updated for the last 150 years, to take into account new data, for example, wars. The founder of the 18-6-year real estate cycle, Fred Harrison, is still alive. And there is a whole team behind it, which is working to ensure that this cycle is constantly updated and up to date. There are two market peaks within this real estate cycle. One is the mid-peak, the second. This is the final peak. The first one. The mid-peak, or as it is also called, the mid-recession, is caused mainly by an overheated stock market, while the second peak occurs before the recession caused by the land market. Why is this important? because land involves people from all over the world and all income levels, while stocks are mostly owned by the top 1% of the population. This means that a recession caused by the land market, or the final recession, is much more destructive, because it affects absolutely everyone. And if we apply the same concept to the Banner cycle, then we can see the following changes. The first row marks the peak of the real estate cycle from the very beginning, that is, the final recession, and row B. This is the mid-peak and mid-recession, that is, less destructive. So, what was known before? The fact that row A marks the peak of the real estate cycle from the very beginning, that is, the final recession, and row B. This is the middle of the peak, the middle is the recession, that is, less destructive. However, interestingly, according to new data from the updated 18 to 6-year real estate cycle, since the Second World War, everything has changed for the Banner cycle. That is, since 1945th year, the final peak of the cycle switches from row A to row B. In other words, after the Second World War, row A now indicates the middle of the cycle, that is, a less serious recession. And row B now indicates the end point of the peak, that is, a more severe recession related to the land market. Thus, we can say that the Second World War actually shifted the timings between the final peak and the middle peak. Why did this happen? Because military policy can easily affect the land market, its ups and downs. The fact is that during the Second World War, states changed priorities in the allocation of resources. They changed the level of public spending, and they changed the priority of economic tasks. That is why it is very important to be aware of such changes. This will help you understand when there will be a strong change in market dynamics or in cycles. Now, looking at the dates on the Banner cycle graph, you can see that row B indicates the next peak in the real estate cycle. And this is 2026th year. Given that the Banner cycle can be wrong for a year, and based on all of the above indicators, this peak can be expected at the end of 2026 or in the middle of 2027.